Yeah, so as Jess said, I'm going to run through just some tax year end considerations, plannings, and things that, I as a financial advisor would be discussing with my clients. So before we start, I'll go through the usual risk disclaimers. So they're up on the screen for you to read. And the ones I would like to point out specific to this webinar are that the tax legislation could change. Some of the investments that I am going to be discussing or mentioning are high risk investments. So they may not be suitable for everyone, and they can be quite volatile. So the structure of the webinar, I'll go over the basics. So, when is tax year end, the basic planning opportunities, specific things to think about this tax year end. So I'll go over some of the changes that have been implemented. And then, the last back end of the slide will be how you can utilize opportunities that exist now that, we foresee not being available in the near future. So to kick things off, tax year end is on the 5th of April every year. So the start of the new tax year 23-24 begins on the 6th of April 2023. And the initial things to be thinking about, making a list for yourself, which will assist in sort of this type of planning, is your total income. And total income can include rental income, earned income, investment income, and bank interest, which is becoming more prevalent in this economic environment. Also very important is the actual performance of your investments. In various wrappers, performance is important, and how that performance is derived. So as I mentioned, is it coming from interest? Are we getting dividends? Or have you, realized a capital gain or a capital loss in this tax year? Savings and interest earned, as I said, is becoming more and more prevalent in the economic backdrop that we've got going on at the moment, with a high level of base rates, and something we haven't seen for sort of the last 10 years is that you'll be getting a sort of real return on your deposits and cash-based savings. Pensions, very, very important every year. If you are a high earner, it's very tax efficient. If you are on the high end of high earners, a bit more complex calculations to do. And if you're a non-earner, you can still make use of pensions. And I'll go through specifically why we recommend that in a bit more detail. And then the final thing is gifts. Something that people don't, isn't sort of the top of everyone's list when they think about tax year end planning. But gifting can be a very, very efficient way of minimizing inheritance tax on your estate. And there is a few simple sort of annual exercises that you can do to make use of those. So we kick off with your allowances. So your current allowance sort of highlights these. These aren't exhaustive of everything, but I believe they're the most prevalent for listeners on the call. So personal allowance is relevant to your income. So the personal allowance is £12,570 per annum. And that has, as I'm sure you all know, has been frozen until the end of the 2027-28 tax year. So that level, is going to remain static for the next four or 5 years for your tax-free allowance. Personal savings allowance, I've put in here for the purposes of illustrating, the exposure on bank interest that you would have, on direct deposits and interest earned. So that is relevant in your marginal rate. So if you are a basic rate taxpayer, you can earn £1,000 of interest tax-free. If you earn over 50,000, which makes you a higher rate taxpayer, you halve that, so you get £500 as a tax-free allowance for interest. Additional rate payers, which currently is earnings over 150,000, you are then an additional rate taxpayer, and that is nil. So as an additional rate taxpayer, all of your interest is taxable. Dividend allowance is £2,000 per annum, and the annual exempt amount, which is relevant to your capital gains tax, is £12,300 currently. This next slide is going to show you the changes for next year. So on the 6th of April 2023, you will see that the personal allowance remains the same. As I said, it's frozen, and we won't see any inflationary related rises in that rate, which earnings have gone up. Everyone would be earning slightly more, which freezing the allowances actually is going to bring more people either into a taxable environment or exposed to a high rate of taxes throughout the band. Additionally, on income, from the 6th of April, the additional rate band is going to be lowered to 125,140. So you can see, there's that extra £25,000 of income that you would have been a higher rate payer, you would now be an additional rate payer. So that then becomes relevant for your personal allowance, so personal savings allowance, where I would expect we are going to see a lot more people, being exempted from that and actually having no income, savings allowance available to them. The dividend allowance is being halved. So the dividend allowance from the 6th of April is going to be halved to £1,000 per person. And your annual exempt amount for capital gains is again being halved down to £6,000. So that's kind of the backdrop, and why we're looking for, why I'm going to expand on what planning we would do in this tax year and considerations for the structure of your savings and investments for next tax year and thereafter. So initially, the sort of more simple structures, the more well-known structures to everyone are ISAs. So ISAs is individual savings accounts, and they are tax-free investments. So up to the limits there, you can see, an adult over 16 years of age can contribute up to £20,000 per tax year into an ISA. Children, from birth up to 18 years old, up to their 18th birthday, can contribute you can on their behalf contribute £9,000 into a junior ISA. Now that you may have noticed, so you've got the 2 years from 16 to 18, where those children actually have the eligibility to receive £9,000 into their junior ISA, but also invest £20,000 into an ISA of their own. Those 2 years in the middle, your child has to use a cash ISA structure. They can't open a stocks and shares adult ISA until they're 18. But there is that, the 2 year window where you can actually save £29,000 into a children's wealth. So yeah, the ISA webinar we've done, we can refer back to it on what you can hold in an ISA, and they're becoming more and more flexible. So ISAs that we advise on, and most ISAs that are out there on the market, are actually flexible now. And what that means is that you can withdraw money from an ISA and put it back in without, breaching the allowance, so long as it's within the same tax year. So, in practice, if you had a short-term cash need, 3-month cash need of £50,000, and you had that available in your ISA, you could withdraw that. withdraw that from your ISA in, say, May 2023. So long as you put that £50,000 back in the same ISA before the 5th of April 2024, you haven't used your allowance. You've just used the flexible nature of that ISA wrapper. And I think, this is going to become more important where, more people are going to be exposed to high rates of taxes. Allowances are coming down. It makes it less attractive to liquidate other assets that may incur a tax liability if you have the ability for the flexible ISA there. So moving on to pensions. Pensions, a very hot topic, very, very tax efficient investments. And the difference between the main difference between a pension and an ISA is obviously a pension is restricted to retirement. So you can't take money back out of a pension until 55/57, and depending on your age. The annual allowance for a pension is capped at 40,000 or your earned income. So your earned income is primarily from trade, so self-employment, from PAYE related income. It actually excludes rental income and it excludes investment income. So relevant earnings are very, very important for this. If you are a non-taxpayer and you still have an allowance per person of £3,600 per tax year. So the grossing up element of the tax relief on entry on the contributions that you make mean that, in very, very simple terms, the £3,600 for a non-taxpayer actually costs the investor £2,880. That then gets grossed up by relief at source in a pension scheme. So, you get that immediate 20% uplift. So, something to really think about. Investments in a pension are tax-free. So dividends, income, capital growth is all exempt from taxes. And then, so additional considerations with your pension, as I kind of touched on very, very early on in the webinar, is the highest of high earners. So if you earn, or if your adjusted income is over £240,000, you lose £1 of the 40,000 per £2 of income, and that the tapered annual allowance actually goes all the way down to £4,000. So pensions have become quite restrictive for those very top earners. There's other things we can consider and then discuss for you if you fit into that bracket. Adjusted net income again is important. So adjusted net income, for the purposes of the tapered annual allowance, what that does is it adjusts your, you add back your employer contributions to your income to get the adjusted amount, which leads on to the calculation for the extent of the tapering. Adjusted net income also is very, very important for those, that have income in the 100,000 to 125,000 bracket. So a pension contribution actually extends those brackets. So in essence, what it does is it earns you back your personal allowance. So your personal allowance is lost in the same manner as the tapered annual allowance. So for every £2 of income you earn over 100,000, you actually give up £1 of your personal allowance. So a pension contribution could be very, very, very efficient for some people that are in that bracket. Child benefits also, with the rates staying the same and the bands not increasing in any way, your earnings may go above these thresholds just by natural sort of inflation linking and earnings growth. So pension contributions in both of those areas, could save you a lot of money. Should you wait to next year? So the reason I've put this in here is primarily to make considerations on the changes that I referred to at the beginning of this webinar. So the lowering of the additional rate band, the freezing of allowances, and potential income increases that you will have. So, are you in that position where, okay, we've got earnings that could contribute to a pension in this tax year, but the net return and the net savings on the new brackets after the 6th of April, would that afford you more tax relief? Would that be more beneficial to you? Because pensions have the ability to have carry forward allowance. So carry forward allowance is the ability to contribute over and above the £40,000 within your earned income, but look back and use the last 3 years' allowances to do so. So it's not a breach of the annual allowance if you have allowance in this year that you don't want to utilise in this year. It would be more beneficial for you to utilise it next year and year after potentially. That you have the flexibilities with pensions to do that. And I think conversations with advisors and clients, these are the pressing factors that kind of guide the decisions. Should we hold off for 2 months to make the payments, so that we actually, for someone earning £130,000, they actually could make a contribution so that they are not additional rate taxpayers, and therefore they would receive the personal savings allowance, dividends are taxed at a lower rate, and things like that. So definitely something to be considering in the lead up to the end of this tax year. Other investments that are a bit more sophisticated, but they are tax incentivized investment schemes. So the budget, hasn't made any changes to these. They haven't, restricted any of the relief that HMRC offer. These are, UK-centric startup entrepreneurial companies, and I would expect these, the relief and efficiencies of these to continue. I've put venture capital trusts at the front of this because they have different, venture capital trusts have different sort of structures and reliefs as opposed to enterprise investment schemes and seed enterprise investment schemes. And it's all primarily focused on income. So if income is a target, you want to generate a bit more income, you already have taxable income, venture capital trusts are great. So they afford you 30% of income tax relief initially. You can invest up to £200,000 per tax year. You hold them for a 5-year period to keep the relief. But the biggest factor with VCTs is that they have a tax-free dividend. So these structures are not capital gains focused. They are income focused, as I said. So the returns are distributed back to the investors in the form of a dividend. Crucial facts that dividend is not taxable. So if you are a high rate taxpayer and you're looking for further income, that tax-free dividend is very, very attractive. These are higher risk investments. They are made, for high net worth and sophisticated investors. So highly recommend that you talk to an advisor to sort of get a recommendation and assess the suitability of these. Moving on to EIS and SEIS. So these structures are more focused on gains. So they generally do not distribute any income through the life of your investment, but they target anywhere from 2 to 10 times return on a capital growth basis. EIS, you get 30% initial tax relief, the same as VCTs. SEIS, you get a 50% income tax relief. CGT deferral, so, as I said, CGT allowance is being halved, so that's coming down to £6,000 per annum. EISs allow you to defer that tax. So, that you don't settle this capital gains tax liability whilst you make the investment. SEIS, you actually get a 50% reinvestment relief. So should you be, higher rate taxpayer, additional rate taxpayer, your capital gains tax rate would be 20 or 28%, which you can halve that by using the reinvestment relief. Both EISs and SEISs, the minimum holding period for qualification and to keep the exemptions and the reliefs is a 3-year period. Historically, they are much longer holdings, much longer term investments than like 3 years, because you have to remember you are investing, in startup companies that you're using your funding for growth. On the way out, so when the gain or loss is realized, the gain is exempt from capital gains taxes after that 3-year period. If there is a loss, if you realize a loss on this investment in both EIS and SEIS, you are eligible to claim loss relief. That is it's different to a carried loss or capital loss that you report, because it is relieved against your income in that year. So you actually get income tax relief on your loss, which we know right now income tax rates are a lot higher than capital gains tax rates. So that is sort of the final benefit. Should anything go wrong in these investments, there is that loss relief on the way out as well. So as I touched on there, SEISs and EISs are very, very effective for capital gains tax exposure, whereas venture capital trusts don't actually, don't relieve or defer capital gains taxes at all. So there I've just recapped on the rates for a basic rate and higher and additional rate payers. The key point on this slide is the reduction in the annual exempt amount. That annual exempt amount is currently £12,300. From the 6th of April 2023, it's going down to £6,000. From the 6th of April 2024, it is being halved again all the way down to £3,000. So that is very relevant to any of you who have investment properties, who have unwrapped investments, personal portfolios, general investment accounts, things like that, there's not much allowance for realization of gains any longer. Capital gains tax exempt amount is essentially lost. It's a use it or lose it relief. So you cannot carry forward any unused relief, any unused allowance until into the next tax year. So it is one of those things that should we crystallize positions before the end of the tax year to actually solidify that gain or loss in the year you want it in. And yeah, of course, some investments do make losses. With very, very volatile and tough market conditions in this current tax year. So there may well be losses in the portfolio that can be crystallized, or investments that can be crystallized, and you can carry those forwards. So long as they are crystallized, you would keep a note of them, you report them on a tax return if you do one, and that can then offset any future gains. There are some strategies that we always use. I like to point them out in these webinars. They are predominantly interspousal transfers, so a transfer between married couples, partnerships. They're not liable for capital gains taxes. So you can gift direct assets between each other, and there is no capital gains exposure on that transaction. The reason it would be relevant, is each individual gets the 12,300 now, or has the ability to utilize a 12,300 gain exposure. So, larger portfolios, or any portfolios with a gain on, if you can split them in half between spouses, then, you actually maintain that sort of 24,600 of capital gains realization that is tax-free. Bed and ISA. So Bed and ISA is essentially, crystallizing positions in unwrapped investments and rehousing them within an ISA. So in doing so, you move from an unwrapped tax-exposed environment into an ISA environment, which is, as I said, tax-free. Rebalancing unwrapped investments. So, if any of those are in, invested portfolios, market-related assets, you have the flexibility to choose, when those assets are bought, sold, switched across to a different asset. And there may be situations where, look at the portfolio and say, is it worth me, making a switch now? Because I can use my annual exempt amount for that switch. Just remembering that after, in the next tax year, you'll only have 6,000 of allowance to use. The final one is for basic rate payers. So capital gains tax is marginal, like income tax. So, the part of the gain that falls within the basic rate band, when added on top of your total income, is taxed at 10%. So, 10% is a lot lower than other tax rates that we've got in the UK. So making use of that 10% over and above the annual exempt amount may be something to consider. And then, yes, just to reiterate that this is a use it or lose it. There's some situations where it's not going to be efficient. But in the likelihood, it's just something to really think about while that allowance is above 12,000. Moving on to sort of the final part of your allowances, I've brought in inheritance tax back to this presentation. Inheritance tax receipts are going up and up and up every year, and we see it reported by HMRC that they are receiving billions in inheritance tax every single year. You do have allowances that can be used in very efficient ways. You can use trust structures, or you can gift directly to an individual in any way. So the annual gifting allowance is £3,000 per person, which can be carried forwards to the following year. You can't carry it forward above 1 year, but you can essentially, if you've never made a gift before, you could make £6,000 per person in this tax year because you didn't make any gifts in 21-22. There are other gifts you can utilise, so small gifts of £250, unrestricted, that deem £250 to various parties, and they are just immediately exempt. Wedding gifts as well, so wedding gifts for £5,000 is a nice one to be aware of. Benefits of these is obviously the 40% inheritance tax saving that you get immediately. So a worked example, as I sort of just mentioned there, so 21-22, an individual did no gifting. We are now 22-23, so the tax year we're in now, that individual has £6,000 as their gifting allowance. So they bring the 21-22 gift into 22-23, and then thereafter it would be an annual exercise just to tick the box using that £3,000 per person. The saving on that, is a staggering £2,400 for the 6,000 gift, and then £1,200 thereafter. So IHT planning and tax planning is a structured, a structured exercise, and the longer you engage with it, the more effective these things are. So that built up over 10 years, 10 plus years, is a lovely tax saving for your beneficiaries. So since we have all the changing backdrops and we've got the changing tax rates and allowances, there are a couple of things that I guess tips from me that are specific to this tax year. So the first one is actually to do with your state pension. So your state pension is in, if you are eligible for the new state pension, if you're a man born on or after 6th of April 1951, or a woman born on or after the 6th of April 1953. That means you will receive the new state pension rather than the basic state pension and any additional pensions that you built up through your lifetime. So this hint and tip is specific to those people that have the new state pension eligibility. And what it is to do with is the ability to top up your national insurance record. So if you are if you are yet to reach your state pension age, or you reach your state pension age after 2016, before the end of this tax year, you can actually look back to 2006 to 2016 and fill in any gaps in your national insurance record. And this is very, very important for those of you who may have been contracted out in any of your pension schemes, or we're giving up benefits into SERPs or additional state pension via your occupational pension scheme. You would have gaps in your national insurance record, or you may have gaps in your national insurance record, and they will impact your state pension starting rate for the new state pension. There is a contracted out pension equivalent charge that has been structured into the new state pension structure. Therefore, I highly, highly, highly recommend that if this is a tool, relevant to any of you, that you check your national insurance record and your state pension forecast, which can be accessed on your Government Gateway login. And then the final one is wrapper considerations. So where we have historically, had a very high capital gains annual exempt amount, we've also had high allowances for dividends, savings rates, and things like that. Then a unwrapped investment, managed in an efficient way was great, and you could utilize all of the allowances. I think more prevalent, when that allowance comes all the way down to £3,000 for capital gains, will be when this is most prevalent and most clients will think about it. So the factors that are in contention and consideration when we think about where we are investing and how we wrap them up for tax exposure, the factors there are that the personal allowance is frozen, the reduced threshold for the additional rates, which in turn may reduce your eligibility for allowances. The high rates of dividends that we've got currently, and they are being retained moving forward. The most prevalent is the stark reduction in the annual exempt amount and the dividend allowance. So when I am talking about wrappers, I'm predominantly, sparking a question on bonds. And when I say bonds, I don't mean, underlying investment assets. I mean the actual structure of an investment bond. So either an onshore bond or an offshore bond. And what these do are create a tax shelter. It's essentially a tax deferment vehicle. You have a lot more control on when you want to realize gains, take income from the product, and expose yourself to taxes. versus in an unwrapped investment, there's natural dividends, natural interest coming from those investments that you hold. So a consideration and just some numbers, to spark some thoughts. And, as always, we're here to sort of follow up if there are any questions on this. But if, for example, if we had a unwrapped portfolio of FTSE All-Share investments, and we were looking at the yield. So we were looking predominantly at the dividend yield that is produced from those underlying investments. It's currently about 3.6% is the running yield. And these numbers here, so the numbers, the 55,600, 27,800 and 13,900 is essentially the relevant amount that you could have invested in that stock portfolio of the FTSE All-Share, and that natural dividend that would be created. You can't choose to take it or not take it. Choosing an investment, you would have that yield. So 55,600 based on a 3.6% dividend yield in this current year would keep you within the dividend allowance and therefore non-taxable. As the dividend allowance halves over the next 2 years, you can see that the investment balance before you are exposed to dividend taxes is going to half as well. So the impact on that can be followed through on capital gains, capital gains tax allowances. Look very, very similar to this in the fact that how much can I realise, and my target return in my portfolio. If I realise that every year, am I liable for taxes? Wrapping up investments is again something I would definitely advise that is discussed with myself or your financial advisor. But yeah, as I say, it's becoming more and more prevalent now, just for that overriding control and flexibility it gives you. And I think that wraps it up. So yeah, if there are, I see Jess is back.
I just thought we'd have a little look, see. We've only got one question come through, so let's have a little look at that for yourself. So, Tim, do gifts need to be declared by HMRC?
No, they do that. Yeah, HMRC do not need to know about gifts. What you do, or what we recommend you do, though, is keep a gift record, and it's a personal document for yourself. We use a spreadsheet, so if you would like the template for the gifting record, I'm sure we can send it over. But it's for your beneficiaries and for the executor of your estate to prove to HMRC in the probate process that you have used these gifts are in your allowances and you are utilising that exemption.
Lovely. Okay, and we have got another one. And that's from Brian. Similarly, do donations to charity need to be declared to HMRC?
If you are someone who does a tax return, they would be included on your self-assessment tax return. If you want to claim an additional rate of relief or a extension on your basic rate band that gift aid donations do, then yes, you have to go via HMRC. Otherwise, no. Gift aid donations, that the charity would claim the additional back from HMRC themselves. But of course, if you want to benefit from the tax relief, then yes, you would personally report them.
Perfect. And I think that's all of the questions. Oh no,
Thanks.
Another one's just come through last minute.
That's fine.
Let's have a look. Andy. How does capital gains tax on a second property be affected if you're allowed 12,500 now and then 6,000 in the future. How does that work?
So your capital gains tax is relevant when you crystallize or you realize a gain. So while you own the property and there is a gain on paper, so you would say, I have made £10,000 on this investment. It's not realized, so it's not relevant in this tax year. When you sell the property and the sales proceeds realize a gain, in that tax year, that's when it's relevant, and you would only get the relief available in that specific year. I hope that answers.
I've got another one here from Darren. If interest income alone takes total income into the next tax bracket, do you get the tax-free interest allowance relating to the lower or higher tax bracket?
So if your interest income pushes you into the additional rate, so let's say you have 149,999 of earned income in this year, and you have £10 of bank interest earned, you would be deemed an additional rate taxpayer. So your earned income would follow the marginal rate. You then add on your bank interest to that earned income. You then realise you're an additional rate payer, so you would then pay, the full marginal rate on the £10, £10 of bank interest that you've earned.
Lovely. And yes, we will be sending out a copy of the presentation by email a little bit later on today. And then we've also got Andy. Just said thank you. So I think that's the rest of the questions done now. Claire, have you got anything you'd like to add to the
No, I mean, I would just say it's an important year, for tax planning, and with all the changes coming up, it can feel, might feel a bit overwhelming. But we're here to talk to you, and your advisor, myself, would be more than happy to go through any questions that this may have raised.
Perfect. So we do have the survey. So like I mentioned before, if anyone has got any time just to leave some feedback, we would greatly appreciate it. And off of the back of what Claire just mentioned, when you leave the webinar, you will be directed to a landing page in case you did want to book in some time or book in a seat for our next webinar, which will be next month on the 23rd of March. So we hope to see you then.
Thanks.